All right, gentlemen. So we just got those PCE data sets, all right, on basically, unpacking inflationary data based on the personal consumption level, all right? So this is really, really important in as far as it fits into the grand scheme of things. Remember where we're at, right? The Fed is looking to maintain price stability and maintain conditions that can create maximum employment, right? Those two things, that's their dual mandate. Now, if you look at which data sets they're using to assess whether they're doing a good job in either of those two fronts, they're looking at, on the labor front, they'll be looking at NFP, all right? They'll be looking at initial jobless claims, all right? They'll be looking at the unemployment rate, all right? They'll be looking at average hourly earnings. Those kind of data sets. For inflationary, to check where they are on price stability, they'll be looking at data sets such as CPI, such as PCE, such as PMI, manufacturing and services, all right? That is all inflationary data. Now, the data that we got today is speaking towards that inflationary side of that dual mandate, all right? And let's have a look at the figures. All right, let's have a look at the figures real quick. The expectation on a month-on-month in as far as core PCE was that it would come in at 0.1%, which is a decline from the previous month before that, all right? The actual figure that we got was flat, all right? So that's good. Inflation is not going up. The difference between the price of goods and services month on month in May last month did not increase. They remained steady at 0.1%, all right? The figure that matters the most, however, is the core on the year-on-year, all right? This is the figure that they want to get down to 2%, guys. Every time I say that the Fed is looking to get inflation down to their target of 2%, I refer to this figure, right? And in order for you guys to really understand why this figure matters so much and why this 2.6% holding steady is significant, we need to go into the past. Okay, so let's do that. All right, let's see why this figure matters, because we just don't want to take it in isolation. All right, let's look at the data. Let's look at this year, just from this year. Not even from this year. Let's look at last year, this time, where PCE data was sitting. So just to give you guys some context, here we are, May. We're sitting at 4.7%, guys. Can you see that? 4.7%. So the Fed has made progress getting inflation down. Do you see why this the number that we got today, this 2.6, do you see why it's so important?
Yes.
Proper. All right. What do you think this means for the Fed? Now, that's what we need to price into our thinking. What does it mean for the Fed? Because ultimately, their analysis of it and the market's analysis of it is the middle ground at which we want to meet, right? That's the middle ground where we want to meet. We understand, what does this information say for the Fed? Says that they're making progress towards 2% significantly. If you compare where they were last year this time, even if we compare from this year, all right, let's take it from January. We're sitting at 2.9%, all right, 2.9%. It remained flat throughout the year, and finally we have that crack right there, all right? So you can clearly see we are in a downtrend, ladies and gentlemen, all right? We're in a downtrend in inflationary aspects, all right, which is a good thing for the Fed, because right now interest rates are at a 21 or 22 year high, if I'm not mistaken, all right? And the reason that's going to make them come down is only going to be if there is progress or inflation, or if there is an unemployment recession. Okay, now already we're seeing, and as far as the jobs numbers are concerned, that the labor market is pretty healthy, right? Even though it is cooling, and that's reflected in the initial jobless claims that we got yesterday, which is still at historically high levels. But let's deal with inflation before we go to in yesterday's initial jobless claims. Then we'll wrap it up with a chart and tie it all up together and see why the price action is moving as it is. All right. So in terms of inflation, we were at 4.7% last year this time. We made all our way to 2.9% in January going into the year, and now we're sitting at 2.6%. So there is clear progress, right, towards towards that 2% target. Great stuff. Now, that's great for the Fed and great for interest rates coming down. All right, when interest rates come down, it's going to be negative for the dollar, and it is bullish for risk assets. All right, so it's a buy. This information tells us it's a buy. Okay, now let's go to yesterday's data, and there we go. Bob's your uncle. Look at that figure. All right, the expectations was for 236k. All right, coming down from 239. Right, so we're still within that 230 handle. All right, now we need to understand why this number matters, and in order to do that, we need to go back into the past. Let's do it. I want you guys to understand that you cannot take this information in isolation. All right, you need to see where we're coming from to understand where we are and where we could possibly go, because that's where the trade is. All right, let's look at from January. All right, going into January, jobs, initial jobless claims, which is the US equivalent of unemployment insurance fund, UIF, filing for when you lose your job, we were sitting at 214. All right, from 214, look at where we're going, 224, 218. We're still ranging below 230. All of this, boom, May, finally we get the 230, guys. We finally get the 230 in May. All right, boom, look at that. That's the highest number since, all right, in the beginning of the year, in the first half of the year. Now look at where we're at right now, 233. So this number, these last three initial jobless claims, guys, represent the highest rate of job losses in the US economy, guys. So they are making their way down to fulfilling what they need to in order to bring down inflation. The only way to bring down inflation is to raise interest rates, which then increases the cost of acquiring capital, increases the cost of borrowing, all right, which means people have less money to spend monthly. All right, so what that does is slow down the economy, and finally it creeps into the labor market, where you find jobs being lost. All right, because of the reduced consumer spending that's a result of what am I saying? That's a result of the higher interest rates and the increased debt obligations that are incurred. So this is necessary medicine to slow down the economy, and we're seeing that reflected in the labor market. We're seeing that reflected in today's PCE figure coming in lower. All right, so both these the information that we got this week is pointing towards a slowing down economy, slowing growth, cooling labor market, cooling inflation. It's all saying buy, 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 buy. Now let's look at the chart. All right, we should see some dollar weakness based on this information. And what do we see? This is today's price action. Look at today's price action, guys. All right, we started our day over there. That's the high of the day. The high of the day made an M formation. There's our neckline. Price came back, created that point. That's the neckline. We have our second bounce there. What do we have there? There's our first break of structure. All right, there's our first point of interest, pointing towards a sell and a weakening dollar, which should correspond with a buy on the opposite end, which is what we're looking for. Right, now let's go to our chart. Since then, you can see the dollar is weakened. All right, it's on the back of the data that we're getting. All of this is on the back of that data we're getting, and we're going to make our way down to this region down here. Right, and as the other clues that we can see, we clearly have a trend line coming up here, an ascending channel. One touch, second touch, third touch. All right. Then we have our break of structure right there. We have our break of structure right there. It's a beautiful pattern when you look at it on the dollar index. It was clearly pointing towards dollar weakness. All right. There's a shift that's happening in global monetary policy, and it's starting to happen in the US now. We're starting to see slower jobs, progress on inflation, and that's what's leading to the weakness of the dollar because of the prospect of low interest rates. All right. This is really beautifully explained. I hope you guys get it.
Yes.
This is even the data is the data is lining up with the chart. You can see it, guys, clearly.
Yeah, 100%.
Right? Cool. Now let's look at a chart. Right. Let's look at gold. Let's look at an asset like gold. All right. Look at gold. Let's check on the 4-hour first. First and foremost, we can clearly see we're still in an uptrend, all right? We can also clearly see, if we look for context over here, we're still in an uptrend. All right, that structure is still bullish. We have our high of the range located in this area over here. All right, and what we have over here, okay, higher high, we have our first high there, higher high, higher low. All right, there's our high of the range, there's our low of the range. All right, since then price has come back to test this area, not break above it. All right, what do we have here? We have a descending channel. Look at this pattern. Right, this is a bullish continuation pattern, and the outcome for this pattern is high probability of this happening. Bullish on risk assets, bullish on gold. All right, so your job, guys, is to look for entry positions using proper technical analysis. Okay, now we can try and filter down this trade to a high degree of magnification, so we can just look at possible entry points. All right, so what we have, we've got the structure over here. This is our point of interest, all right? And what we're seeing, preceding that structure, we had a reversal pattern, a clear reversal pattern.
Yes.
Yeah, we had a clear breakout, a clear reversal pattern. This whole structure, what's going to happen over here is a continuation pattern. We're likely maybe to see a pullback to this area, boom, explosion to the top. Or it could just continue all the way from where it is right now. All right, the market will ultimately do what it does. Also here, we can clearly see we had a bullish continuation pattern. All right, we have an impulsive wave, we have a corrective wave, and this could be our next impulsive wave. All right, that's at 1, 2, 3. That's at 1, 2, 3. All right, you guys understand? And what we also have, a pattern within a pattern. We also have a head and shoulders, guys. Look at this. There's a head and shoulder pattern. All right, we've got the shoulder there, we've got the head there, and we've got the second shoulder right there. It's screaming by me. It's screaming by me in every way. I don't even know what more to say, guys. The data aligns.
Yeah.
The fucking chart aligns. I'll leave the rest up to you, all right?
No, for sure.
All right, gentlemen. I think that's it. Any questions?
Why is Nasdaq going opposite?
See, I cannot explain that because I haven't looked at it, but it could be a pullback towards New York Open, all right? You could be waiting for 4:30 maybe, all right? So just be cognizant that there could be some pullbacks before price actually does go eventually bullish and flip over. But the data that we've had this week points towards a weaker dollar, a Fed that a Fed that's constantly gaining confidence that inflation is coming back down, and therefore they can possibly cut interest rates in September and give us another cut before the end of the year. That's what the market is hoping for, and that's what's going to be the reason that risk assets are going to be propelled to the moon potentially.
Yes.
All right.
But they said it could be sooner.
Could be sooner. It'll all be data dependent. All right. The Fed has told
Yeah.
us that they're going to be data dependent. If inflation shows signs of being sticky, then they've already told us. Several Fed officials have already told us that if inflation is still sticky, they will leave the door open to increasing interest rates appropriately. All right. But if it comes
Yeah.
down, then they will have the scope to cut. Right now, the data tells us
But
that
so far it's
they're
going
getting
as
this.
planned.
Exactly. Right now, the data is telling us that they are gradually gaining the scope to cut. And that's why there's this positivity in these assets, such as gold, such as GBP/USD, and other risk assets as well. All right. But
Yes.
particularly today, I chose to stick with gold because it is giving a pattern that is so beautiful, and it aligns perfectly with the data that we saw today, particularly because it is interest rate sensitive and inflation sensitive. Okay.
Yes.
All right, gentlemen, we will talk on WhatsApp. I bid you
Thanks,
farewell.
boss.
Cheerio.
Thanks, boss.
All right, guys, take care.
You too.
All right.
As you too.
Shout out, guys. Shout out. Thank you for joining. All right.
Shout out.
Where?
Away.